Yo, what up, guys? Get in here, Pete. Welcome.
Wait like a minute or something.
No, it starts broadcasting immediately. Thank you for coming to Sang Lucci Mailbag, guys. This is Thursday, January 16th, and we got Peter Zhang here and myself, Charlie Bathgate, to answer all of your trading questions. Lucci has the bird flu, so
The bird flu.
He's
you know how he got the bird flu.
yeah, you don't even want to know.
You don't want to know.
New Year's Eve party got real weird, real fast.
Mad birds.
Anyways, so Lucci's out sick. We hope he survives and comes back next week. But until then, we are here. So let's jump right into it with your questions, starting with Faisal. I think I probably butchered that pronunciation, but he says, just have a quick question. I'm a bit scared of starting out trading in options. I feel like that they are very risky and quite complex. Do you think people should start out trading equities or other asset classes before moving into options? Thanks in advance. Keep up the awesome work.
You should definitely trade equities first. Problem with equities is that you have small accounts, and it's really tough to be able to trade when you are under PDT and you can only trade three times in a week. So if you can start off with equities, because obviously the exposure is way different than with options. If you want to start off with options, I would recommend just going small, picking the right options, and putting a lot of constraints on yourself in terms of what day you're willing to play, so you don't have too much decay against you. But overall, I would trade equities first before you trade options.
What is that? What about? I feel like we get a lot of crossover between people coming from penny stocks to options. You feel like just because the gains you can get, the potential, the moves?
Yeah, I mean, like, people that are in penny stocks, you guys got to understand that, like 20,000 shares could move the entire stock 10 cents. And half the stuff you guys play are pump and dumps. Literally 30 seconds later, the stock could just get halted and dump an entire buck or two. That's just the way these penny stocks and pump and dumps work. And yeah, it's like a rite of passage, though, going through penny stocks and trading penny stocks. It's cheap.
Everyone starts like that.
Everybody starts at penny stocks essentially, because it's cheap enough for smaller accounts.
Yeah.
And you could try to hold shorts for multiple days to catch like a big short on a pump and dump. But most of the time, you make some, you lose some, and then you just lose it all. But it's the game of trading where you just have to learn how to lose some money in order to really learn what to do and what not to do. So those of you that want to seek the thrill ride of trading, good luck. And if you don't have seatbelts in the markets, you're probably going to get smoked. If you want to get into options, you may get lucky with an option, buy one and it goes to 24 bucks, but I can tout the whole, penny stock, Sykes, I'm going to freaking make $1 million on this trade kind of thing. Yeah, I could talk that way, but again, you guys need to take the necessary steps. You're going to lose some money, you're going to lose a lot of money, and then you're going to start realizing that there's actual real risk management that comes along with trading, and that you can't just go willy-nilly throwing darts at a board and hoping that things will go your direction. So if you're in penny stocks, I'd recommend go ahead. Get it out of your system. If you do survive, you will learn that there is an entire world outside of penny stocks that you can actually exercise real trading strategies to really take advantage of really big market movers. Not to say that penny stocks don't have them. There are certain companies that actually do catch a lot of momentum that actually have real plays with them. I would just say that you should be very careful of the pump and dumps out there, because they're just so, they're called pump and dumps for a reason. They're volatile for a reason. There's no options on them for a reason, because it's just too dangerous.
Yeah.
And if you don't understand the entire game of mailers and momentum, and subscribers that get things first and then second and third, and where you are in the food chain, most likely you're going to get chopped up. So yeah, take your time with it, but if you want to learn options, obviously learn from us.
Yeah, and I think one of the hardest things for people to get their head around when they come to options is the concept that that they don't exist forever, right? And all experienced option traders out there, this is just complete. This is number one thing you learn first. But like for people who are new to it, it's hard to get your mind around the concept that these things are going to go away. They're going to expire literally after a certain amount of time. What you bought no longer exists, right? And obviously there's ways to play that to your advantage, but just conceptually getting your mind around that is important. And yeah, you can find all kinds of stuff on the site about this. We write about it. Lucci's ebook. You can put your email address right on the front page of the site. Mm-hmm. Good conversation about that concept. So word. Musso was talking about. Big shout out to Zach Musso too. What's up, man? We was talking about LinkedIn today, and he was like, it's a good example of something you guys should cover this afternoon. Pretty awesome intraday move after jerking around all week. Combines tape reading over the week and patience of stalking a move. Plus, because it was Thursday, those weeklies must have been going buck-ass wild this AM if you diagnose the move early on.
Yeah, I was I personally was in LinkedIn long and Netflix short. If you looked at Netflix yesterday, it was a fantastic dump too. And I was in LinkedIn long with short puts from Friday that were like $2.30, and then I was in Netflix short via the short calls, and those were about $2 or whatever, and it was a timing issue, and they were just not properly timed, and the moves happened without us. But whatever, it happens. But yeah, LinkedIn had a great move today, and yeah, that's just kind of what happens,
Yeah. What the hell was I just going to say? Oh, I guess Q crushed this in the chat today. He got it from like 24 cents, the LinkedIn trade, and got out at $1.24. Guys, the people in our chat have been murdering it.
Yeah, people lately. In our chat have definitely been crushing it. While Lucci's been sick, everybody in the chat has literally been slaughtering the streets out there.
Yeah, which is cool, which is very cool, because it shows that you guys don't need Lucci to be sitting there holding your hands. If you guys can do this stuff yourself, that's the whole point of it, man. So that's very, very cool. Big props to you guys. Good job, Q, on crushing that trade.
And just overall, guys, the LinkedIn trade today, for anybody who had smaller accounts who could not short options to capitalize on decay, is really, really good. It's Thursday. It is Thursday, right?
It is Thursday.
Thursday, and your options are really, really cheap, even if they're somewhat, close to the money. And you could definitely snag, a penny player and take it up to $1 or $2. On Thursdays and Fridays. Those are like the cream of the crop trades out there, when you can get a really big move on Thursday or Friday, buy an option for like 5 cents, sell it for $1. And yeah, those are obviously the best.
The weeklies, yeah.
For the weeklies, yep.
Yeah, I mean, I think that's why there's so much crossover with penny stocks going into the weeklies, because guys see the same price moves, right? I mean, they're happening for completely different reasons.
Yeah. So penny stocks, yeah, you're looking at things that are 80 cents that move to $1.50, $2.
That happens on Friday all the time.
And that's an options move, in general. And the only thing is, you only have so much time before your option's worth nothing. So.
Yep. All right, so we got some good questions from Ryan Wong. First one, what are the differences and techniques when reading the tape in level 2 with options compared to futures and stocks?
So reading the tape in general, we have to understand, I'm just going to give you some information that probably Lucci's going to be pissed that we're giving it for free, but reading tape is literally understanding the auction process. You have to ask yourself, do you understand how an auction works? And then you have to ask yourself, is the auction based on first come, first serve? Like, is the guy in line right now willing to buy? Is he the one that's getting served first? And once you just start understanding those concepts, you can apply them across the street. All the game theory and all the poker play and all the blackjack moves that you would pull on the tables are the same type of thing you would pull when you're in an auction process. So if you're reading futures, it applies the same way. If there's more demand than supply, your prices are going to go up. More supply than demand, your prices are going to go down. The problem with trying to read futures is that the volume is way freaking high. So the more volume there is, the more likely that the human eye is not going to be able to catch the actual axe. We call it the axe because that's the guy who's chopping the stock down or killing the stock upward. And when you can't see it and you can't focus that well, the likelihood of you making a mistake is higher and higher, and it becomes just a shit show of you trying to learn how to read the tape on a really difficult instrument. So that's why, usually when we teach tape reading, we tell you guys to, look at a Netflix, or sorry, not a Netflix, an LVS or a Win, or even a Goldman Sachs per se, something that doesn't trade that often, but whenever it does get real momentum, you can actually see how the momentum comes in. And
those are your good starter stocks, guys. If you're looking to just get your feet wet with tape reading, don't start out with something like Apple or the SPY or something like that. It's like Pete was saying, it's too similar to futures. It's going to move way too fast for you guys to get a read on it.
Yeah, and the techniques again are relatively same across the board. It's just that you have bigger players and the thicker names. And can you stomach some of the moves that these bigger names have while these bigger players can play them? That's just like with you in a penny stock. Are you willing to let a move go against you 10 cents, still stay in the trade because you know that it's real and that you're dip buying here, versus if you're playing the SPY or playing Apple where it's going to move against you $5 before it actually moves in your direction? And that's just an assessment of whether or not you have the risk tolerance, and two, whether or not you have the mental fortitude to stare at so many quotes coming down the screen and saying that it's worthwhile. And honestly, like one thing you want to take into consideration with tape reading is that one big clue, and we're just going to give it out there, is that you need to always have something to compare it with. Does it have a sector? Does it fall under a certain sector? Are there correlated assets? Are these things moving together? If they are moving together, the likelihood of you having a profitable trade becomes higher. If you don't have anything to compare it to, say for instance you're trading the ES futures, and the ES futures are just kind of, the dictating futures that move things, that are very hard to kind of combine with other futures and other markets for finding some type of correlation there. You're kind of like, you're standing on one leg. You don't have another kind of something to compare relativity with. And if you don't have that relativity, you're actually losing an edge that could be yours, unfortunately, that you don't have anymore. So then you're just based on the actual time in sales and the level 2 that comes through, and then you come back into the problem that we just stated, that it's hard to read because it's so thick.
You just got all philosophical and shit. I've never heard that before.
Oh, wow. I just haven't taught in a while.
Check this guy out, man. All right. All right, and the market structures. Wow, this is a market structure. We should almost bring Chaim over for this. That would be hilarious. And are the market structures for these three markets, do they operate the same?
No.
I.e. market makers, order flow, and HFT.
No. So how do you put it this way? Futures have different types of exchanges. Cash equity markets in the U.S. have different types of exchanges. The way that an order gets processed for futures may be different from the way that orders get processed in the equities market. Actually, I'm going to see what Chaim's doing. Actually, come on. Chaim, you got to come over here for this show real quick. Yep, you got to come over here. Yep.
You guys are about to get a cameo from
Chaim
Bodek here, who could probably build one of these exchanges if he wanted to. This is pretty cool.
Yeah. Chaim. Yeah, okay, so you got to keep it
5 minutes max.
Under 5 minutes
otherwise,
for this explanation.
Because we got more questions we got to answer.
But the question here,
Ryan, I hope you're in this audience, Ryan.
The question is the market structure of futures markets versus the cash equities markets. Are they the same? Are they different?
Futures and cash?
Futures and equities.
Yeah. Cash equities.
Cash equities.
No, totally different. Futures are...
Scoot up and speak loud.
Okay. Futures are quite vanilla, actually.
Yeah.
We do have competition between exchanges, but you don't have, 13 stock exchanges, 40 plus dark pools all competing against one another. The main thing that is kind of critical is there was a body of regulation called Regulation NMS that was rolled out in 2007, and that caused all of the complexity and high-frequency trading advantages and loopholes. It contributed to it because the HFTs basically exploited this regulatory framework. That framework does not exist for futures markets. So, I think quite a number of quantitative traders think of futures markets as safer, actually.
Yeah, I was just wondering, do people feel like trading futures is like the stat arbs out there that are just literally just trying to arb? Is it easier to arb futures than it is with the...
Yeah, in the last 2 years, I've talked to so many future traders and also quantitative funds that focus primarily on futures, and they look at the stock market as just a nightmare and as a
they call
huge,
it like a casino, right?
Yeah, huge tech cost to even just think about just getting all of the data from all of the venues.
Sure.
Right? Dark pools. You have to go to a bank and negotiate with the bank on access. Let me into your dark pool. I mean, it's a whole different world. So, I think to a degree, if you're a retail guy, you are actually quite insulated from a lot of the complexity and of the stock market because your order is probably not even going to an electronic exchange. Usually what happens is a firm like E-Trade will sell your order to a trading firm who will just trade against it. They'll look at the market and say, yeah, I'll match the market, and they'll just trade, and nobody even gets to see that. So, so you don't really actually have a lot of choice as a retail guy in where your order goes, which probably is an advantage in a way because there are a lot of places where you can get really hurt. That being said, some of the trading firms that trade against your orders aren't really that kind to them.
To put it lightly.
Yeah.
So guys, overall, the structures are completely different, and there are different games in different places. High-frequency traders are also in futures, right? I mean, you have a good bit of high-frequency traders in there.
Yeah, but
electronic traders.
I think of it as it's under control.
It's under control.
That's my view.
Okay. It's under control. So that's actually something that we've been trying to push this whole market structure movement in general is that regulators, they wanted to come in and help fix the markets, which is wonderful, enable too much complexity. And then you look at the futures market, which has had its reforms, right? And but not too much complexity was thrown into it. And I don't know if everybody would agree to this, but I would say that the complexity of futures markets allows for a better type of competition than it does in your equities market in the U.S.
So
is that a smart thing to say?
Yeah, sure. Actually,
what's up?
Joffrey actually has a whole web page. I'll look it up and send it over to you, which basically makes the argument that future markets and explains some of the differences, so we don't bore everybody with detail here.
Okay.
We'll put that up, guys. The website that Chaim just referenced, we'll put it up on the page, the Mailbag page where we post this recording. So if you guys want to dig more into futures versus options market structure, you can do that.
Yeah, I mean, I'll be a little bit biased here, but I think of it as the options market is pretty much the most untainted. I mean, future markets are you know, they're better, but they are kind of closed systems. What you have with the options market is you have, you know, is it 10 now? How many option exchanges? We just had Miami launch.
10. No,
I thought it was
Yeah.
13. Isn't
no,
it 13?
That's stock. Well, you have healthy competition, and a lot of the things that I have criticized in the stock market have either yet to be rolled out to the option market, and let's hope they aren't, or if they have been, they've been failures and haven't hurt the investor in the same way. So, you know, like for example, if you're trading, I would much rather trade Apple options than Apple stock. I don't know if you try to, you know, put an order in Apple stock and just sit there trying to chase.
Just trying to get in. Yeah, it's incredibly hard to just get around an Apple on the stock. But guys, what's really important is that no matter what, when you're accessing the markets and you're putting your money at a broker-dealer and you're just trading, you're going to be susceptible to just a ton of user error, which is going to be a huge cost of business, and then a ton of electronic trading risks in terms of just accessing markets with, you know, your flow getting sold wherever it is and your fills not being good. And when you start adding all these negative aspects to trading, it's the reason why you guys have a bad rep, and why we have a bad rep for being 95% losers. Okay, and you know, what's really interesting is that there may or may not be a shift in the broker-dealer world where, you know, there could be firms that are going to help provide seatbelts for traders to be able to, you know, kick themselves out after making a certain amount of gains, and you know, automatically lock yourself out for a certain amount of losses. Just think about that for a second. If you had stopped trading by 11:30 and you did not trade into the afternoon, how much more likely would you have been to save a ton of money? You know, if you were up $1,200 at 11:30, you know, and you did not give it away half of the time or 80% of the time in the afternoon, how much better would you feel? How much longer would you stay in the markets? And in addition to that, what if you had some tools that could help you out? These are just kind of, I'm obviously pumping something here. So these are just things that that are important for you guys to think about as traders and as participants in the markets, that if you're going to try to drive a freaking Ferrari around in the markets, learn how to freaking drive, and wear a seatbelt instead of just throwing a whole bunch of cash at it and just letting it freaking burn in front of you.
What Pete is saying is that he and I have been working extremely hard with the team of guys on putting something together that, you know, we're not quite ready to announce to the world yet. Otherwise, we would just do it. But it could be very, very cool and kind of a game changer for traders out there being able to survive a lot longer. You know, I mean, we've been in the education business for a while now, and even with how good our education is, and we have a much higher percentage of traders who survive and win and go on to become, you know, profitable full-time traders. It doesn't matter, you know, the burnout rate is still pretty high. You know, most traders don't make money, and we're trying to find some technology that can help that beyond just the educational side. So
yeah, I mean, I'll just add just very quickly two dimensions to this. I mean, one is you know, what he was getting at. You know, traders are you know, they're sitting at home. They don't have all the information sources. They're not at a big hedge fund or at a bank, and you got to realize what you're up against, what the other guy is, right?
We always say the other guy, like they, them. There's the other guys. The guys that have money.
Well, I'm thinking about specific. I mean, I've worked with, you know, the other guy for 15 years.
Right,
and
yeah.
What's interesting is he is making a lot of the human judgments that your day trader is making, right? A market maker, name lights up, he gets in there, he says,
I want to play.
I want to play. What side am I getting in? Right? He comes in with the same type of speculative views. But what's happening is, if he's wrong, he can turn his position for free.
Right.
Right? There are risk controls, there's constraints where if he, you know, wanted to blow up, we won't let him. The machine doesn't.
That's right. You cannot blow up. You're not allowed to blow up at these firms. You know, every once in a while you hear about some ridiculous losses, But in general, the idea is like at these big firms where you have a ton of money and a ton of resources, you have constraints all over the place. And as much as that one employee or that one trader may hate it, it keeps them there. It keeps them trading the next day and the day after. And over time, hopefully, they make some money. And that's kind of the thought process of, what if there were a Robinhood firm out there that was helping you guys do the same thing?
I mean, we basically, I don't, what I love actually at working with you guys is, I know for a fact that if you take those guys and you get rid of their tools and you put them out here, they're gonna blow up. They're gonna hemorrhage. They don't know how to trade if it's just they don't have the discipline. Everything
It's like those post-apocalyptic movies, like a Judge Dredd, where you take you have this society and it's all beautiful, utopian within the walls, but then you take some guy, you put him outside in the desert with all the wild men, and he's shitting his pants, right? I mean, that's
so the concept is, can we find good traders and make them great traders,
or even so-so traders, and just keep them alive
with the same concepts that basically underpin the entire market-making industry. And we're talking about techniques that I just can't believe are not available.
Yeah.
That have been around 15 years. You guys have what? Choice of 3 order types?
Yeah.
On our side we have 2,000.
Yeah, so much more fiduciary duties from broker-dealers, right?
All right, well, we're getting off on a tangent, but guys, that was a very cool cameo for Chaim to come out and do for us. He's the star of the Wall Street Code. If you haven't seen it, look it up on YouTube. It's pretty awesome. We might be in it at the end. Very subtle plug there. But we're going to go on to the next couple questions, guys.
All right.
Thanks, Chaim. Appreciate it.
Thanks.
All right, guys. So Oliver has a question. Even as a total beginner, can you make? Wow, this is very timely. Can you make a full-time living trading options within a year after the 12-day course if you are dedicated and persistent enough? Oliver, the answer to that question is yes. If you're saying, can you do it? Absolutely. I mean, we have guys. I was talking to Greg, our intern, this morning about Musped. The guy makes, I'm not going to say how much because he's a very private guy, but he makes a lot of money. He's a very successful trader on his own, and he doesn't trade exactly how Lucci trades. He doesn't trade the same style with the same aggression, but he has the same understanding of how the options markets work and how trading psychology works. He's taken that same information and put it through his own filters and brought out another strategy, and that's part of what the chat and the course is all about, helping you understand the best way for you to execute. We have plenty of success stories. Like we said, the chat room is crushing it. In the last couple weeks, you can see every Friday we put up a post that has a review of what's been going on in the chat room. But it's not a guarantee. Exactly.
It's not a guarantee.
We would never guarantee that. Yeah.
It's ultimately you could learn and be the smartest student, make great decisions, and you could just be pissed one day that your girlfriend broke up with you, and then kaboof, there's your entire account right there.
Yeah, you hit the button.
Are you going to blame? Are you going to blame the education? Are you going to blame the markets? What are you going to blame? The only thing you can do is take accountability for it and try to understand and learn. And the only thing we promise here is that you will learn. As you manage risk and you get to learn yourself, because in trading you're essentially projecting yourself into the markets. You will see if you're a successful trader or not, if you know how to manage your emotions, or if your emotions drive you to make millions of dollars, or if they drive you to lose all your money. So
yeah, professional traders blow up all the time, and people have no idea what they're doing. Sometimes just buy the right lottery ticket. There's tons of chance in the game. But yes, Oliver, the answer is yes. And easy plug here, our next 12-day course begins this coming Monday night. So, if you go to the site, you can check it out. We're offering a 10% discount. Go to sanglucci.com, pull down the services tab, go to the 12-day boot camp. You get a 10% discount there. So, check it out, guys. Lud asked, I'm probably butchering that. Yeah, it's a good question about, basically it has to do with the fund. We can't answer some of this publicly, but to answer your question, Lucci trades a single account, right? There's only one account that he trades. So, I think that will give you the answer to what you're looking for. And, yes, he's trading his own money as part of that account. Do you view, this is from Eric, do you view high open interest as positive or negative when looking to enter exit a position, or do you even look at open interest as a metric?
Open interest is usually the areas where the market makers are trying to make the stock not go towards. So if you look at open interest over time, within, by Tuesday or Wednesday, you'll start seeing a bracket. You'll start seeing the highest level calls, highest level puts, and those usually are the brackets for where the stock will not go through in general. Because again, remember, in theory of trading in general, it's all about where the action is. Market makers are always trying to find where the action is. Highest open interest is where all the action is. If all the guys out there are buyers of those highest open interest areas and these market makers are selling it, they're doing their damnedest job to make sure the stock doesn't go through those areas, to make sure they screw you out of it. So hopefully that gives you kind of like a little bit of an idea of what's going on with open interest and the significance of it. Most of the time, those highest open interest ones are the ones you don't want to be buying anyhow, because when you have higher open interest and more transactions, more bidding and offering, your volatility is higher and all these other options characteristics and supply and demand are higher in general. So that's going to jack up the price of those options. And yes, it may provide you a higher likelihood of being able to get out, but the open interest guys, they most likely are going to get burned from it.
Word. All right, guys, and then last question here from Richard before we bounce out of here. What are your thoughts on selling monthly SPX condors after the regular market closes when the premiums skyrocket? For example, today, the 1830/1840/1850/1860 condor went from around $1.50 at closing to over $2 midpoint from $4 to $4.15.
I would say that if you can get the right condor on, that it's a good idea. If you can actually get a fill for those times, a lot of times when those prices get jacked up, the spreads really widen. And I really wonder, even though you saw those condors go in those prices and those strikes go in those prices, if you could actually get a fill. Because even though the price, say, were $1 by $1.50, and then all of a sudden it goes to $1.80, it could have just gone from $1.50 by $2.50. Okay, that's the spread just widens in certain points. And I would say again, learn to hedge if you're going to be playing those trades, especially if you're selling options. And pay attention to where your bid and where your offer is, because you may think it's a good trade because it looks historically like a good trade, but when you execute it, the spread is too wide and you get screwed, and you didn't really get to capture too much additional premium.
Word. All right, guys. I think that about covers it. Thank you for joining us. Like we said, you guys can always see this recording. If you're watching this right now, you probably don't need to watch the recording. But and we are starting our next 12-day course this coming Monday, 10% off. So go to the site. You'll see it. It's not hard to find. Send us your questions always, guys. Hope you have a great long weekend.
Yep. We'll be here again next week. All right. Have a good one, guys. Over and out.